Welcome, dear traders. Stocks have kicked off the new week in the red. The bearish sentiment seems to persist for a long time. The non-farm payrolls report published last Friday topped expectations. Unemployment decreased in the country. Following such results, the US stock indexes took a nosedive to their two-year lows. In the Asian session, the stock futures also declined. Watch our video review and find out what is happening on Forex. The upbeat non-farm payrolls data served as a signal to the regulator to continue with the aggressive tightening. The Fed can now tighten policy without the risk of a possible recession. The unemployment rate declined. Wage growth keeps up with the rise in inflation. And for this reason, the central bank is strongly committed to bringing inflation to the 2% target. Although the majority of investors have already abandoned hopes for a softer stance, there are still some who are betting on it. Perhaps expectations of a slowdown in the monetary tightening have increased amid Christopher Waller's speech. He said that the Fed could slow down the pace of tightening if the October non-farm payrolls report turns out to be weaker than expected. Prior to the Fed meeting in November, the inflation report is also due, so investors do not give up hopes for a softer stance, as fresh inflation data may show a drop. If the PPI exceeds the forecast reading, it could exert more pressure on the markets and force the Fed to act more aggressively. Last week, several Fed officials made their speeches saying that more rate hikes are necessary to tame inflation. The hawkish remarks dispelled rumors about a shift to a dovish stance. Following the release of non-farm payrolls, the FEDWATCH tool indicated that 90% of traders anticipated a 75 basis point rate hike at the next meeting. And today, only 77% of speculators hold the same opinion. Aggressive rate hikes have an extremely negative impact on the global markets. Foreign traders are more willing to invest in the US economy, which spurs demand for the US dollar. What's more, the greenback is up thanks to a rise in US treasuries. They have been climbing for the 10th week in a row. Apart from that, the US dollar retains momentum as a safe haven asset amid fears of a global recession and escalating geopolitical tensions. It's hardly surprising that the US dollar remains one of the world's strongest currencies. For instance, the pound sterling fell by 0.7% versus the greenback within just 15 minutes after the release of the non-farm payrolls report. Today, the US dollar index advanced to 113.07. After a three-week rally, the index started the week with the gains moving in the upward channel of 112.62 and 113.31. It has already grown by 18% since the start of the year. The only factor that could undermine its beyond rally could be the deterioration of the US economy. However, it's resilient now, and the US dollar is likely to reach new highs. The yen is no longer the main outsider in the currency basket after the Bank of Japan intervened in the foreign exchange market for the first time in 24 years. The yen managed to advance against the US dollar. Japan's foreign reserves dropped by 4.2% after the yen buying and dollar selling intervention. However, the effect seems to be short-lived given the divergence in the monetary policies of the Bank of Japan and the Fed. Last Friday, Japanese Prime Minister FUMIO Kishida said that recent sharp one-sided yen declines were undesirable. He also repeated the government's warning to investors against pushing down the currency too much. The intervention conducted last month reflected the government's view it would not turn a blind eye to repeated excessive volatility driven by speculative trading, he said. The yen was hovering again near the psychologically important level of 145 in the Asian session, and it was trading at 145.43, and the dollar-yen pace slowly but surely moving up in the upward corridor of 145.21 and 145.67. However, at the time of making this video, the Bank of Japan has not intervened or made statements about such possibility. Trading floors in Japan are closed today on the occasion of Sports Day. The Aussie lost momentum due to a fall on Wall Street after a strong non-farm payrolls report and risk aversion. It dipped below the 0.6350 level for the first time since the outbreak of the pandemic. It also weakened amid the risks of a global recession and geopolitical tensions. As a result, the Aussie has become the worst performing currency in the G6 basket. The US dollar is rising across the boat amid the gloomy prospects for the global economy and the Fed's strong commitment to a hawkish stance. In today's Asian session, it's scored new gains. Of course, it's bearish for the Aussie, and the AUD pays a trading in the upward range of 0.6328 and 0.6381. It has already approached 0.6310. Some analysts believe it's a high time to open short positions on the pair at 0.6400 with the prospects of a climb to 0.6050. It appears bearish sentiment is prevalent today. This week is going to be rich in events. The US is going to unveil its inflation figures, and the FOMC meeting minutes are also on tap. Several Fed officials are going to deliver speeches. Apart from that, the earnings season for the third quarter has started. Subscribe to our channel and keep your finger on pulse. See you soon!